If you've ever been offered severance after a job ends, it's easy to think, cool, unemployment, but from the company. That assumption is where people get surprised. By the end of this video, you'll be able to read a severance offer and forecast your next 2 to 3 months of cash flow, including how it can change unemployment timing, taxes, and health coverage costs. Picture this. Your job ends on a Friday. You're offered severance and the headline number looks like breathing room. But your bills don't care about headlines. They care about which weeks you actually have spendable cash. So here's the pipeline. Severance is pay. Unemployment is a state benefit. Severance is money your employer agrees to pay after separation, often tied to signing an agreement. Unemployment is a state program with eligibility rules, weekly certifications, and weekly caps. They don't automatically stack cleanly. 3 rules drive most of the real-world confusion. Rule 1. The shape of severance matters more than the size. Most severance is either a lump sum or salary continuation. A lump sum is one payment after you sign. Salary continuation is paid on a schedule for a set number of weeks, almost like you're still getting paychecks. Why this matters? In many states, salary continuation can be treated like wages paid week by week. That can delay or reduce unemployment for those weeks. A lump sum can be treated differently depending on the state and how the agreement describes it. Back to our example. Say your job ends February 13. You're offered 12 weeks of salary continuation at $1,250 per week before tax. On paper, that's about $15,000. But if your state treats that as wages for those 12 weeks, your unemployment may not become payable until after that period. Month 1 feels okay. Month 3 is where the squeeze shows up. Rule 2, severance is taxable, and withholding can make it feel short. Severance is usually taxable income. The surprise is withholding. A separate severance check can have higher-looking withholding than a normal paycheck. That changes what lands in your account. So, a $15,000 headline might land closer to about $11,000 to $12,000 after withholding, depending on your setup. If you budgeted from the gross, it feels like money vanished. It didn't. It's prepaid taxes. Rule 3. Benefits timing can be a bigger lever than either check. After separation, 3 clocks run at once. Clock 1 is severance. When does it pay? And is it weekly or a lump sum? Clock 2 is unemployment. What is the first week that is actually payable? Clock 3 is benefits. When does your health coverage end? And what does the replacement coverage cost? This is where people get trapped. Even if severance is steady, a new health premium can arrive right when unemployment is delayed, and suddenly the math flips. So, what do you actually check? Check number 1, the severance agreement language. Look for lump sum versus salary continuation, or any wording that allocates pay to specific weeks. That wording can drive how your state treats it. Check number 2, your state's unemployment guidance on severance. States vary. Some treat allocated severance like wages for those weeks, some do not. The point is not to memorize 50 rule books, it's to confirm which one you're in. Check number 3, the benefits end date in writing. Not what someone said on a call, the date in your separation packet, because your real burn rate changes the day that coverage changes. Now, 3 concrete signals to watch as you move through this. Signal 1, the severance structure on the agreement. If it's salary continuation or allocated by week, expect unemployment timing to be more likely delayed or reduced until the severance weeks run out. Signal 2, the first payable week shown inside your unemployment claim system. The date you apply matters, but the payable week is the real cash flow marker. Watch for the first week that switches into payable status. Signal 3, the day your health coverage actually ends. If you don't know that date, you don't know how long your runway really is. Let's make this feel real with one quick scenario, and we'll keep revisiting it. Our person has $900 per week in fixed bills when you average rent, debt payments, and basics. Severance nets about $950 per week after withholding. That's tight but workable. Then health coverage ends and a replacement plan adds the equivalent of $100 per week. Now the burn is $1,000 per week, and the severance doesn't cover it. If unemployment is delayed until week 13, the gap isn't theoretical. It's weekly. That's the reason severance doesn't replace unemployment. They solve different problems on different calendars. One counterpoint quickly. Sometimes severance won't reduce unemployment much, or the delay you feel is just processing. Claims can sit pending, and that looks like a severance issue even when it's administrative lag. So, the practical framing is plan off confirmed cash flow, not hoped for cash flow. Use the agreement language, your claim status, and your benefits end date as your three anchors. Here are decision rules that keep it clean without pretending there's one right move. If you have a solid cash buffer and the severance is paid over time, the main trade-off is speed versus certainty. Filing for unemployment early can get you into the system and start the weekly certification rhythm, even if the first payable week is later. The goal is to avoid starting paperwork after your runway is already shrinking. If your buffer is thin and you're getting a lump sum, the main trade-off is liquidity management. Treat the lump sum like a paycheck replacement. Take the net amount that hits your account and divide by the number of weeks you want it to cover. Then compare that weekly runway to your weekly burn. If runway is below burn, you have a timing problem, not a budgeting problem. If benefits are ending fast, protect the downside first. In our scenario, that extra $100 per week for health coverage is what flips the math. So the immediate question becomes, what does coverage cost starting the first day after the employer plan ends? Because that's the week the budget will feel different. Notice what we did there. We didn't guess about unemployment. We planned for the gap until the payable week shows up, and we adjusted burn for the benefits change date. That's how you avoid the month 3 surprise. Next, here's a 2-minute checklist you can run the same day you get a severance offer, plus a simple way to choose a plan based on your timeline and cash buffer. Here's the 2-minute checklist. First, confirm the severance shape. Is it a lump sum or salary continuation? If it's paid over time, note the start date, pay frequency, and how many weeks it covers. If it's a lump sum, note the expected pay date and whether it's contingent on signing and returning paperwork. Second, confirm the net, not the gross. Look for any estimate of withholding or assume the deposit will be meaningfully lower than the headline. Your plan should use the amount that will actually hit your bank. Third, confirm your benefits end date and your next coverage cost. Write down the exact day coverage ends, then estimate the weekly cost of replacement coverage so you can update your weekly burn rate. Fourth, file unemployment early, but watch one screen. Apply as soon as you're eligible in your state, then focus on the claim portal's first payable week and any instructions about weekly certifications. That payable week is your real timeline. Fifth, build the 3-month cash flow forecast. Week by week, list expected severance deposits. The week unemployment becomes payable, and the week benefits costs change. If there's a gap, you'll see it in plain numbers instead of finding out when your account hits 0. Back to our scenario. The moment you add the benefits cost and you don't see a payable unemployment week yet, you know the risk is a timing gap. That's the problem to solve. If this helped, subscribe to the Wealth Blueprint for more clear money breakdowns. And leave a comment with the next topic you want covered, or the one part of today's video you want explained even simpler.